Hello, this is Arthur Hill, CMT, and you are tuned into the state of the market on Art's charts. So we got a lot to cover today. As usual, it's been a pretty volatile August, and we're going to look at this pickup in volatility. We'll look at the index and sector breadth models to see where they stand. We'll go over the current upswing in SPY as well as do a mean reversion update. And then we'll look at IWM, QQQ, sectors, some key industry group ETFs, and of course, we're going to finish with gold, bonds, oil, and the dollar. Let's get started. So this first chart I've got here goes back 18 months. And what I'm seeing is something similar to what happened in January 2018 and October 2018. And what happened in those two time periods led to months of choppy trading and volatility and indecision in the S&P 500, which of course is by benchmark index. So what is happening here? Well, if you look at January 2018, we hit a new high there. So we get a new high, and then we had a very sharp plunge. And I'm not talking about, a 5% decline over a 5-week period. These are 5+% declines in a matter of days. And then that led to 3 months of choppy trading. You can see we went up, down, up, down, up, down. And we started finally firming in April and then got a nice advance in May and into September. So we hit another new high there in September, and then we had the October plunge. And the breadth indicators, the index breadth model and the sector breadth model turned net bearish there in mid-October with this plunge. And so after this plunge, we had 2 months of choppy trading, up, down, up, and then we had the December decline. So where are we now? Well, you can see we've hit a new high, just like the previous two periods, and we've had a sudden and sharp plunge, just like the previous two periods. Now, I'm not going to go look for the reason for the August plunge. I really don't care about the reason because, truth be told, I don't know why people are selling. I haven't interviewed every seller out there. I know what the financial media says. They're blaming it on tariffs. Maybe they're blaming it on the Fed, maybe earnings, maybe capital spending, maybe the bond market, maybe the Fed, maybe a whole myriad of things could be causing the selling pressure. And if you start getting into these issues of what's causing it, then you have to look for a change in those causes to formulate your position as far as the stock market. And I prefer just to let price tell me what's going on. And when I look at these prior two plunges from new highs and this one that we've had now, and look, we're heading into September and October, that could mean that we're going to have 2 to 3 months of choppy trading or uncertainty. Now, I will not turn bearish until the breadth models tell me to turn bearish, and we'll cover those in a minute. But looking at previous instances, it looks like we could be heading into a couple months of uncertainty. So here's a chart of the S&P 500 going back 3 years, and what we can see is a possible broadening formation. Now, I know if you go to your textbooks, you're going to see a broadening formation is a bearish reversal pattern. But, the question is, when is it confirmed? I mean, is it confirmed with a move below that lower trend line at 220, which is below the December low? That is not my kind of a pattern. And so I think you got to throw out the textbook and you got to look at what is this pattern actually telling us. And if we look at what's happening here, you can see that the swings are widening. And that tells you that over the last 18 months, volatility has been increasing. And then as you saw here in August, we've got an increase in volatility. So long term, we got volatility. Short term, we got volatility. That's not a good recipe for the next few months. So if you look at this, you had a 12% decline. Then you had a 15% advance. That was bigger. Then you had a 20% decline. That was bigger. And then you had a 30% advance, roughly. And that was bigger. So they keep getting bigger. Now, does that mean we're going to have a 35% decline? I don't know. All right. But what I am going to do is I'm going to cue off of the daily chart because I think this is the swing that matters here from December to July, August. All right, this is the current uptrend that I'm watching to see if it reverses. Now, of course, the bears can point to the fact that we did have a failure at that upper trend line there, and we did break support here. So the short-term trend is reversed with the August decline, no doubt about it. But as far as the longer-term trend, it hasn't reversed yet. You can see the 440 PPO is still positive down in the indicator window. There's the 40-week average, and we're above that. There's the last reaction low, and we're above that. In addition, we did hit 52-week highs, 2 of them in 2019 at least, and we hit one just 3 weeks ago. So a 52-week high is still bullish in my book, still indicative of an uptrend. So I think the evidence on this chart still favors an uptrend. But let's look at the daily chart to decide what would it take to turn bearish. So here is a daily chart for SPY, and there are 3 things that tell me that the trend is still up on this chart, and there you can see I've got them in the box there. So we have the 20-day is above the 200-day, price is above the 200-day, and price is above support in the 272, 278 area. This is SPY. It's a proxy for the S&P 500, which is my main benchmark for the stock market. So it ain't over until the 800-pound gorilla in the room cries uncle. All right, I know small caps are lagging, but until the S&P 500 breaks down, we don't have a bear market. I'm sorry. So if we look at this chart here, we can see there's the 20-day above the 200-day. 20 days turned down. Maybe that's a short-term issue. 200-day is slightly rising there. And you can see down in the indicator window, we got an interesting thing happening with RSI. So if you look at this May decline, you had the first decline, and that set up a mean reversion opportunity. You're oversold after this initial decline in May. RSI was below 30. And then we got the bounce. And you can see RSI hit 50 and couldn't get above 50 and turned back down for the second leg. And you got a little mean reversion bounce, and we're going to go on that in detail in the next chart. And then you got a lower low, basically another move down. So you had the RSI double dip, and then you had the breakout there in early June that reversed that momentum indicator and put it back in bull mode for well over a month. So if I look at RSI now, it's hitting 50, and we've gotten our mean reversion bounce. So we could get another test of the 200-day maybe, and this support zone here. But again, I'm not bearish yet. I need more selling pressure to turn long-term bearish. Now, mean reversion trading is not for everybody. It's a very short-term trading strategy, and usually you are trying to catch a falling knife and you're exiting with a small profit. You're not looking to let that profit run. You're looking to grab it when you can. And so looking at this SPY chart and looking at mean reversion here, you can see in May we had that sharp decline. And you can see that RSI moved below 30 and actually below 20, so it was very oversold. 20 is the red line. Stochastic didn't get oversold. The percent above the 20-day EMA did not get oversold because it didn't go below 20% there. And at the bottom, you can see we had an outsized decline. In other words, you can see the rate of change was below 2% for one day. So we had 2 of the 3 indicators lining up. So it wasn't a great oversold opportunity, but still, we got a bounce. But in order to profit from that, you would have had to buy near the close here and then sell after, say, a 2% gain when you got that bounce. You wouldn't look to trail your stop or anything. So if we go to the May-June low, you can see we had a very sharp decline. We have RSI going below 20. We have the stochastic oscillator below 20. We have the percentage above the 20-day EMA below 20. So 3 of the 4 were telling us that we had a serious oversold condition there, and that was right here. So if you had bought in that 275 area, you would have had a decline right after that, but then you would have had a nice sharp advance. And you probably would have been out long before this part started. All right, maybe you could have trailed on the lows as it went up and locked in some profits. Now, if we look at the current situation, we had this 60% decline in 6 days. And look where it found support, right around that 61.8% retracement. But in order to profit from this, you would need to be buying in that 285 area, all right, near that close. You would have been trying to catch the falling knife. Because if you bought on this bounce, well, yeah, you could have sold on the close here. But ideally, you're trying to catch a falling knife with a mean reversion trade. So you can see RSI was below 20. Stochastic was below 20. The percentage of stocks above the 20-day EMA was below 20, and we had an outsized decline. And that often happens at the end of an advance or the end of a decline, short term. You get the biggest move of the move, so to speak. So you can see we're starting to decline, and the rate of change has its biggest drop here. It looks like the sky is falling, and then we get our bounce. So that's the way mean reversion trading happens. And, if you've been entering at 285, I think you would be out at 292. As far as a true mean reversion style trading, you just take that profit and you move on. So that's the way it looks now. If you want to do some classic chart analysis here, you have a bit of an island reversal working here because you have the gap down, the stall for 3 days, and the gap up. So, traditional technical analysis would say as long as this gap holds, so call it 287.5, then we've got a bounce underway. But if we fill that gap, then maybe we're going to start to decline and have a test of these lows from March and June. All right, now let's look at some breadth indicators. I'm going to start with a couple of short-term indicators, which is the one-day breadth thrust, and then we're going to look at the indicators that are part of the index breadth model. So first of all, we've got AD%, which is advances minus declines divided by total issues. So if you have 90% of stocks up on one day within the S&P 500 or S&P Mid-Cap 400 or S&P Small Cap 600, then you have what's called an 80% day. All right, it's a 90% up day, but with 80%, you do advances minus declines. So you had 90% up minus 10% down, you get plus 80%. And of course, you have 90% going down, that's a minus 80% day for 80%. So you can see I've got some triple 80% down days in May. We had 2 of them, and that led to the correction. And the correction ended with a double 80% up day when we had the S&P 500 and the S&P Mid-Cap 400 clearing 80%. And then you can see we had one here. Now, you're going to say, well, wait a minute. That's where we got the mean reversion bounce. What's going on? I thought that minus 80% down day was a bearish signal. Well, come on. This is the stock market. Nothing is clear cut. All right, there are edges that you're looking for. You're looking for the odds of something happening. And if you've already got a decline and you get a big outsized decline, that often gives way to an oversold bounce. That's pretty normal. All right, but the thing is, we had a double 80% up day here. So that's kind of negated that triple minus 80% down day. So it's kind of like a push right now, if you will. And as I said, as long as that gap holds from the surge that we had on Thursday, I think the short term is okay. But if we get another double minus 80% down day, watch out, I think. So here is AD volume percent. So this is advancing volume minus declining volume divided by total volume. And we're doing it for the same 3 indexes, the S&P 500, the S&P Mid-Cap 400, and the S&P Small Cap 600. So together, these 3 indexes make up the S&P 1500. You've got large, medium, and small caps, and you've got around 1/3 stocks. 1/3 of the stocks are from the NASDAQ, and around 2/3 are from the NYSE. So this is a really great data set to use for your breadth indicators. So you can see here it doesn't quite match up with the AD% readings, but we had that minus 80% down day there in May, mid-May, and that gave way to a small oversold bounce, and then we got another decline, and then we got a double 80% up day in early June, and that set off the June advance. That's kind of like a rocket thrusting up. And then you can see we got a triple minus 80% down day on that decline we had here in August. And so that kind of set up it was oversold already, so we got an oversold bounce. But you can see on this bounce, only one of them moved above plus 80%. So it wasn't that strong on the volume category. Ideally on an upthrust, I would like to see 2 of the 3 participate on AD% and AD volume percent. And we didn't get that with that bounce we got on Thursday. All right, now we're going to look at the breadth indicators that make up the index breadth model. And we had 2 new signals this week. There you can see the 10-day EMA of 80% moving below minus 30%. Now, this is more of a medium-term indicator. The 10-day EMA of 80% measures a breadth thrust that signals we could be in for the start of a advance or decline that could last a couple months. And it's usually the first signal to trigger of these 3 breadth indicators. The other one's high-low percent there, and the percentage of stocks above the 200-day EMA. Those are more trend indicators. They lag a little bit more, and they're used kind of for confirmation. And the 80%, the 10-day EMA of 80% is kind of like your early bird, early warning. You can see that this indicator triggered there in January for the S&P 500 here. And the other indicators didn't confirm until early February. Sorry, this is January, and then early February, the other indicators confirmed with that move on February 5th. So we've been net bullish since February 5th, but we've got our first shot across the bow with that bearish breadth thrust. And if we get another one of these turning, like we get the percentage of stocks above the 200-day moving below 40%, that would flip this group bearish, but it hasn't happened yet. Here are the same indicators for the mid-cap index, and you can see we did not get a bearish breadth thrust with 80%. The 10-day EMA did not move below minus 30% there. It came close, but didn't move below. High-low percent has yet to trigger bearish, so these 2 remain on bullish signals. The percentage of stocks above the 200-day did move below 40% this week, and that was a bearish signal. And finally, small caps. Now, the small cap index is the only one that is net bearish. It's been net bearish since March. It had a breadth thrust in January with the other 2 indexes, but you can see the high-low percent indicator never got above plus 10%. So it never reversed that signal from October there. And you can see the percentage of stocks above the 200-day EMA did get a bullish signal in February, but it reversed in March, and it is yet to move above 60%, and it's had a couple moves below 40%. So 2 of the 3 indicators here remain bearish, and you can see small caps have done nothing here since March. So when you put all these breadth signals together on a table, you have what I call my index breadth model. And it has been net bullish. In other words, at least 5 of the 9 indicators have been on bullish signals since February 15th. And currently 5 of the 9 indicators are on bullish signals. And there you can see the 2 new bearish signals, percent above 200-day EMA for mid caps and the bearish breadth thrust for large caps. But again, I look at a weight of the evidence approach when it comes to the broader market. I look at that price chart. 20-day and the 200-day is my key trend indicator. And then I look at these indicators, and you can see 5 of them are still bullish. And when one of these flips, then I will turn net bearish on the broader market. So now we'll move to the sector breadth model. This, of course, is based on the 11 sectors in the S&P 500, whereas the other breadth model is based on those 3 indexes, includes mid caps and small caps. This is just large caps and large cap sectors. But it's the same principle. It's the same indicators. There you can see the 3 indicators there at the top. And then you have the bearish signals in red. And you can see in August, we had a number of new bearish signals. We had 1, 2, 3, 4, 5 new bearish signals in August and 2 new ones this week. So we had breadth thrust. And you can see we had breadth thrust coming from 5 of the 6 big sectors: finance, technology, communication services, consumer discretionary, industrials. And the only one that didn't trigger a bearish breadth thrust was healthcare. So of the big 6, healthcare held up the best as far as I'm concerned in August. And then if you look at energy, it triggered as well, but it didn't change anything because it has been net bearish since May. Don't even look at the XLE chart or the XES chart. I'll have oil coming up, but when these indicators are all on bearish signals, you don't even look at this chart, I don't think, because it's not a leader, it's a laggard. There are plenty of other better opportunities out there than in energy. Now, as far as the strongest sectors are concerned, we still have the most strength coming from staples, still no bearish breadth thrust there. All 3 indicators are bullish, and utilities, REITs, and materials. So what I do is I do these signals. You have, say, 2/3 bullish here, and I multiply that by the sector weight, and you can see 2/3 bullish signals. That'll be a net bullish signal of plus 14% over there on the right. And then I add them all up, and we're at plus 69%. So the sector breadth table is still clearly bullish. Until it starts getting below 50%, I wouldn't be concerned. If it goes below 0, then you've flipped to negative and you're bearish. So it ranges from minus 100 to plus 100. And when it goes negative, that's when you're net bearish. So that's what we'll be looking for going forward. But right now, I go by the Dow theory, trend follower type motto. Trend is in force until proven otherwise. I don't look at potential things that might happen out there. I look at what the current situation is, and that dictates my stance. And right now, I'm bullish, but you can see we've weakened. All right, I would say I'm 70% bullish on the market right now. And you can see the index bottom model is 5 of 9 bullish. So we're not 100% bullish. There are pockets of weakness out there, no doubt. And that's why I'm thinking we might be moving into this choppy trading range for a couple of months. So let's check in on QQQ and IWM, and I've also added SPY to give a comparison here. So you can see we had a 52-week high in SPY and then a sharp decline, 52-week high in QQQ and a sharp decline. But both of them are above the June low there, which is the green line. That's the first significant support level. You can see that QQQ is further above that June low. And then you look at IWM. Clearly, it does not belong. It's the different one of these 3 because it's been in a trading range since March. You know, you've had a couple of pullbacks and then what looked like, a breakout here didn't last long, a pullback and a breakout didn't get much traction. And so it's going nowhere, underperforming. And you'd have to say, is this going to bring down the market? Well, no, it hasn't brought down the market. Small caps have been lagging for months, if not years, and they haven't brought down the market. All right, the market comes down when you get breakdowns in QQQ and SPY. Then you have a true bear market. And until then, you can still find stocks and sectors and industry groups that are in uptrends. But if SPY breaks down, that's when I would consider moving totally to cash and forget about trying to pick uptrends. But that hasn't happened yet. Right now, the best thing I can say is just avoid small caps because they're seriously underperforming and there are better opportunities out there. Right now, as far as the sectors are concerned, I've got the big 6 sectors here. I apologize if this chart looks a little bit small. I've had to narrow it a little bit to fit it all in the video. But the reason I want to do that is I want to show all 6 together on one chart. And this is also in Friday's written commentary, where you can see that in a bigger chart format for more details. But what we've got here is I've got a red line marking the high from late April, early May, and I've got a green line marking the low from late May, early June on each chart. So you can see XLK hit a new high, that's bullish. XLV did not, that is not bullish. XLF did hit a higher high, that's bullish. XLY hit a higher high. XLC hit a higher high. XLI did not. XLI is the laggard of these sectors, as is XLV. But then you look at the green line, you can see none of them broke support here. All of them are holding above support. So that is net positive. But the weakest one, I think, would be XLI. And if it breaks support, that would be negative. Now, all is not lost for XLV, because if you just look at it since May, you can see there's that high from late April, early May, the red line, and we're back above it now. So XLV is showing some relative strength here in August, because you can see none of the other ones are above that red line there, whereas XLV has managed to do it. So again, I saw XLV did not get a bearish breadth thrust. XLV has this big, massive consolidation, and it's the only one that is back above that red line, which is the high from late April, early May. So there might be something happening there. But if you start to see these big sectors break support, the green lines, that's going to add to the bearish case. All right, now let's look at the other 5 sectors. Now, the first 6 sectors account for 78% of the S&P 500. They are the main influencers of broad market direction. These other 5, not so much. You got consumer staples, you've got energy, and then you've got materials, utilities, and REITs. And again, we've got the red line there marking the high from late April, early May. And we've got the green line marking the low from late May, early June. And so you can see which 3 are above the red line. That would be staples, that would be utilities, and that would be REITs. So we have staples, utilities, REITs, and healthcare above the red line. They are holding up the best right now. They are the defensive sectors. XLE, as I said, don't even look. It's in a downtrend. It's the weakest sector by far. So if we look at the green support lines, we're above support for staples, above support for materials and utilities and REITs. So right now, nothing has broken that May-June low. And once we start seeing breaks there, that's when you might start to see the breadth tables turn and my stance on the market turn. So now I want to look at what I think are the 10 strongest industry group ETFs out there right now. And it's not in any certain order, but what these industry groups have in common is they've done something like they hit 52-week highs in July. There you can see semis hit 52-week highs, these stocks. They're above support here, which is the green line. Again, we got the red line, the green line here on these charts as well. So we can see home construction, ITB. It's above the red line and it's above support. It looks like an ascending triangle, which is a bullish continuation pattern, and it's on the verge of a potential breakout. We got nice moves in DR Horton. Semiconductors remain pretty volatile, but the trend is still up here until we break down below that support level there. The cybersecurity ETF SIBR is stronger than HACK. It hit a 52-week high there. It had a sharp pullback, but it is above this support level here. Then we look at the FinTech ETF, FINX, 52-week highs, and it's above support, so it's still doing okay. And the Mobile Payments ETF, iPay, 52-week high, sharp pullback, but it's the only one that's above that red line there. All the except ITB. It is the strongest, I think, of these 5 right here, the iPay ETF. But if we do move into an uncertain period for the next 2 months or so, then that could lead to volatility in these as well. So software is still looking okay. It got hit pretty hard, but it did get a bounce. We got to look at the overall trend here. The overall trend is still up, and you don't have major problems unless you start breaking support here. The aerospace ETF ITA is looking strong. It hit a 52-week high there, had a sharp pullback, but look, it's back above the red line. So this one remains strong and in an uptrend. So I do like defense. REITs are very strong too, one of the few that hit a new 52-week high this week. The solar ETF also hit a 52-week high, and it remains well above support and well above the red line. So it's one of the stronger ones. And the medical devices ETF is above the red line, and it hit a 52-week high in late July. It is also one of the stronger industry group ETFs. So there you have the top 10 industry group ETFs. So now let's turn to the intermarket arena. We're going to look at TLT, the Treasury Bond ETF first, and it has made a monster move since that low in September, October there. So we got the first breakout, a little pullback in the form of a wedge, and another bigger breakout earlier this year. We had a little bit of a stall heading into the Fed meeting, and then that big breakout and surge over the last 2 weeks. So it's getting a little bit frothy for my blood, but the long-term trend is clearly up, and that means we probably want to turn to the daily charts and look for bullish setups. But it might take a little while for a bullish setup to emerge. In other words, some sort of flag or falling wedge continuation pattern. If we look at the 30-year Treasury yield, it is back near the 2016 levels. That's 2.1% roughly. 21 on the chart. This is $TYX. You can see over there. It's updated during the day. That's why I use that symbol. But you can see you had a little consolidation and a breakdown. So it is heading to new lows. It's in a downtrend, and that could be helping housing. But I don't want to get a narrative going there. I want to look at the chart for ITB to get my reasons for being bullish on housing, and I showed that. Here is the gold SPDR GLD, and you can see that it's had a major breakout there in that was probably in June when it broke to new highs, broke out of a 3-year consolidation. The best signal there, well, first of all, you had a little breakout there off the bottom, and then you had a couple of bullish continuations patterns form. The best one was this falling wedge that hit that reversal alert zone, and then you had the big breakout and the big surge there. So we had a little bit of consolidation there in June, July, and a surge here in August as the market fell. So it's like the bond market. It's just getting out of control, and I would just let things settle and let this market come to you. Wait for a bullish continuation pattern or a bullish setup to emerge on the daily chart. Here is West Texas Intermediate crude, and I am bearish on crude. You can see the big breakdown there in the latter part of 2018, and then we had a big move up and hit that reversal alert zone. You can see the 61.8% retracement area, broken resistance turning into broken support turning into resistance, and then the breakdown. And we had a second smaller reversal alert zone there a few weeks ago, and we broke down again. So yeah, we've got this big hammer this week, but I think the bigger trend is down. There's the falling 40-week moving average, and you can see the PPO 440 has been negative since May there. So the long-term trend for oil is down. Here is the dollar ETF, and it is in a clear and present and persistent uptrend here. It just continues to work its way higher. You had that initial surge there in the April, May area of 2018. And from then, we've just been working our way higher. And of course, on the mirror side, you have the euro working its way lower. Now, the yen has been moving higher since the breakout there in April. The yen is kind of the risk-off currency. So when it rises, that suggests a risk-off whiff in the air, if you will. And that kind of suits what's going on with the volatility in the stock market. So we've got gold rising, we got treasury bonds rising, we got volatility rising in the stock market, we got the yen rising. So that's telling you that some risk off is creeping on into the stock market, into the financial markets, and that means we could have that volatile period in the next few months, or the next coming from now until the end of October perhaps. So in ChartWatchers on Saturday, I wrote on how to find stocks and sectors that held up during the onslaught. So we got hit hard in August. What could you look for to find things that held up? And so what I've got here is a chart of the S&P 500, and you can see that there's the 50-day EMA in green. So we broke below that 50-day EMA, well below it, and that's kind of like a benchmark EMA. So anything that held the EMA, held above the 50-day EMA, showed relative strength, relative chart strength, and we can scan for that. So if you look at the PPO, it's the difference between the one-day EMA, which is the close, and the 50-day EMA. And when it turns negative, as it did there, that means the 50-day EMA has moved below the close has been below the 50-day EMA. And if you look over to the left, you can see the settings there, PPO 150, 0. When you add 0 for that last parameter, it creates it as a histogram because there is no signal line. 0 is the signal line parameter. So if you scroll down, or I'm scrolling down, there you can see it's a very simple scan code. I want stock as in the S&P 500. I want the minimum value over the last 5 days of the PPO to be above 0. In other words, it didn't go below 0. And I want the close to be above the 200-day. I just want to make sure the stock is in an uptrend. So I can highlight that line. I can copy it. Whoops, I hit select all. I'll highlight that line. I'll copy it. I'm going to go to the advanced scan workbench here, and I'm going to paste that in, and then I'm going to run the scan. And it will give me stocks this week that are in the S&P 500 that held up better than the market as a whole. And so you can put these into a chart list and view these to see if you find any that suits your parameters. And I went ahead and did a sort to see which stocks and which sectors were holding up. And then if we go back to the article, I've got a table. And we can see that as far as the percentage of stocks within each sector holding up, the winner was utilities sector. Utilities and REITs held up by far the best. So you can see 43% of utility stocks held above the 50-day EMA, and 38% of REITs held above the 50-day EMA. And we can see healthcare was next with 26%. So a respectable showing from healthcare, and technology was the weakest with the most stocks. 90% of technology stocks moved below the 50-day EMA, whereas only 10% held above. Well, sorry, energy was worse. So what I've got here is I've got the total number of stocks, and if you'll notice, not every sector has the same number of stocks. You can see that healthcare, and I'll change that to an arrow, healthcare, industrials, financials, consumer discretionary, and technology have over 60 stocks in the sector, whereas utilities and communication services and materials and energy have fewer than 30 stocks. So that's why you have to divide the total number of the number of meeting the scan criteria by the total number to get your percentage. So 12 divided by 28 gives you 43%. But the bottom line is utilities, REITs held up the best. Healthcare held up better, as did staples. And we had a lot of selling pressure in consumer discretionary and technology in August. would like. That concludes this State of the Market video. Thanks very much for tuning in and have a great weekend.